Welcome to The Explainer. I am absolutely thrilled you're here today. I want you to think of me as your personal financial guide for this session because we're diving into the ultimate roadmap for protecting your hard-earned savings. Today, we're looking at something humanity has obsessed over for literally thousands of years, yet it somehow remains one of the most misunderstood financial tools out there today. I'm talking about gold. We're going to break down exactly how it functions as the 5 millennia anchor of sovereign wealth, and much more importantly, what that actually means for your pocketbook. Let's dive right in. Here is a quick look at our roadmap for today. We're going to cover 1. The silent wealth transfer, 2. The 1971 fiat experiment, 3. Gold versus fiat currency, 4. Nature's perfect money, 5. Why central banks are hoarding, and 6. Viewing gold as insurance, not an investment. All right, let's kick things off with Section 1, the silent wealth transfer, and how inflation moves your money. Now, most of us are taught that inflation is just this natural economic force, right? Kind of like the weather. Sometimes prices just go up. But that is definitely not the whole story. Inflation is actually a stealth mechanism. It's a hidden, completely silent engine that continuously transfers wealth away from responsible working-class savers holding cash and hands it directly to borrowers and the asset-owning class. Get this, since the United States completely severed its currency from the gold standard back in 1971, the US dollar has lost an astounding 93% of its purchasing power. Just stop and really think about that for a second. If you had a dollar in 1971, the equivalent purchasing power of that paper today is just 7 cents. You didn't spend it, you didn't lose it on a bad stock pick, it simply evaporated through the sheer mechanics of our modern monetary system. To put that into perspective, this dynamic perfectly highlights the difference between paper money and real money. Let's go back 2,000 years. A Roman centurion was paid roughly 1 ounce of gold per month. With that 1 ounce, he could buy a high-quality toga, a leather belt, and a sturdy pair of sandals. Fast forward to today. That exact same ounce of gold is currently valued somewhere between $4,000 and $4,700. And what does that buy you today? Well, a high-quality tailored suit, a nice belt, and a great pair of leather shoes. Hopefully no toga, though. But the absolute crucial point here is that gold's value didn't actually increase. The paper dollar just lost its value, while the gold stayed perfectly still. It's a true measuring stick. Moving right along to Section 2, the 1971 fiat experiment and the end of the gold standard. You know, we tend to look at our current unbacked paper money, what we call fiat currency, as just the normal way things have always been. But historically speaking, it's actually a highly volatile 50-year experiment. Let's walk through the timeline to see exactly how this played out. Back in 1944, under the Bretton Woods Agreement, the global system was anchored to gold, and the US dollar was pegged right at $35 an ounce. But by the 1960s, massive government overspending meant the US was printing way more paper claims than they actually had gold sitting in the vault. Other countries caught on pretty quick. France even sent a literal warship to New York to collect their physical gold. This pressure led directly to the 1971 Nixon shock, where President Nixon permanently severed the dollar's link to gold. And by removing that physical anchor, it paved the way for the years 2020 and 2021, where the government managed to print 40% of all dollars currently in existence in just 18 months. Unbelievable, right? And that brings us to a fascinating concept called the newspaper moment. You see, currencies and empires usually don't just collapse overnight. They suffer a guaranteed slow bleed of purchasing power. It's a lot like the decline of printed newspapers. It happens slowly and almost imperceptibly over decades, and then one day you look around and realize the whole old system has practically disappeared. Well, cash sitting in a bank account is experiencing its very own newspaper moment right now. So let's look at Section 3, gold versus fiat currency, and break down the core differences. We absolutely need to clearly define the fundamental differences here between finite physical metals and depreciating paper money. On one side, fiat currency relies entirely on unlimited paper printing. On the other, gold has a strictly finite physical supply. Fiat is a 50-year social experiment. Gold is a 5,000-year universal currency that was agreed upon by ancient empires that never even spoke a word to one another. Paper money is constantly subject to foreign policy and sanctions, whereas gold is geopolitically neutral. It literally has no enemies. And finally, fiat guarantees debasement over time, while gold stubbornly retains its purchasing power across centuries. Which brings us to what financial historians like to call the Midas rule. It's an incredibly simple concept, yet it's the ultimate guide for everyday savers like us. The Midas rule basically states that you preserve wealth by tying your value to assets that governments absolutely cannot create out of thin air. You simply have to follow what cannot be printed. All right, section 4, nature's perfect money. Let's talk about elemental engineering. The Egyptians, the Romans, the ancient Chinese, they didn't just pick gold out of a hat. They chose it because of its chemical, completely unalterable traits. First off, extreme scarcity. If you were to gather all the gold ever mined in human history, every pharaoh's tomb, every central bank vault, every wedding ring, it would fit into just 3.5 Olympic-sized swimming pools. Second, corrosion resistance. Gold does not rust. It does not tarnish. You could pull a gold coin from a 400-year-old saltwater shipwreck, wipe it off, and it looks identical to the day it was minted. Add in its perfect divisibility and incredible malleability, where just 1 ounce can be hammered out to cover 100 square feet, and you have an indestructible physical asset that was essentially engineered by nature to act as money. That leads us to section 5. Central banks are hoarding. We need to start following the smart money. Look, if you want to protect your wealth, you really have to watch what financial elites do, not what they say. Publicly, financial commentators and central bankers love to dismiss gold. They'll call it a barbarous relic or mock it as an outdated pet rock. They basically tell everyday working-class investors to just stick to paper assets and ignore the shiny metal. But wait, behind closed doors, over 1,000 tons. That's right. In recent years, while publicly dismissing gold, central banks worldwide went on a massive, record-breaking private buying spree, acquiring over 1,000 tons of physical gold. It's a staggering level of hypocrisy. They are quietly front-running the public to de-dollarize their own reserves. So why are countries like Poland, China, and India stockpiling gold at an unprecedented rate? Simple. Because they're hedging against a looming $40 trillion U.S. debt load. They watched $300 billion in Russian reserves get frozen overnight, and they suddenly realized that paper money can easily be weaponized. Gold, on the other hand, has no foreign policy. It cannot be frozen by an adversary. By acquiring physical gold, these nations are deliberately shifting away from dollar dependence. Finally, let's wrap up with section 6, insurance, not an investment. It's time for a mindset shift. So how should everyday savers like you and me actually treat this asset? To use gold effectively, we really have to completely reshape how we think about its role in our portfolios. A super common criticism is that gold doesn't pay a dividend or it has a low yield compared to a hot tech stock. But honestly, that's missing the point entirely. Stocks and real estate are yield-generating investments. They carry risk and they're designed to generate cash flow. Gold is not an investment. It is financial insurance. It is a 5,000-year measuring stick. It acts as a lie detector for paper currency, just patiently sitting there, preserving your wealth while governments debase their money. Expecting gold to act like a tech stock is kind of like expecting your home insurance policy to pay you a weekly dividend. It makes no sense, because that's just not what it's built for. And this is exactly why this explainer matters so much for you. Leaving your hard-earned wealth entirely in cash guarantees a slow demolition of your purchasing power. You probably won't even notice it on a random Tuesday, but over 10 or 20 years, it puts your most important long-term milestones at massive risk, whether that's finally buying a home, putting your kids through college, or retiring with dignity. So I want to leave you with this final provocative thought to ponder. As you plan for your future, ask yourself, over the next decade, will you store your hard-earned financial energy in an unlimited paper system that has already lost 93% of its value, or will you anchor at least part of your wealth to a 5,000-year-old physical standard? The math is clear, the history is basically indisputable, and the central banks have certainly already made their choice. Now it's time to make yours. Thank you so much for joining me on The Explainer today. Stay curious, stay informed, and I will see you next time.